one thing that happened was, a long time ago, is anyone here from sort of the Pennsylvania, Ohio area, aside from Phil? No? Okay, well, how about New York? Really? I'm at WashU, in business school, there's nobody here from New York. Someone's lying to me. The two companies, they were both, banks or financial institutions. They decided to merge. They said, we have the Bank of New York Mellon over here. We have the Bank of New York, company over here, and then over here is Mellon Financial. We think we could do really well. We're going to merge. They called it a merger. The newspapers called it a merger. It was not a merger. One company bought the other. Because at the end of the day, they had two sets of stock trading, one for the Bank of New York Mellon. I don't remember what their ticker symbol was. The other for Mellon Financial, which is their ticker symbol was and is BK. So you can look up the details of the transaction. I'm not exactly sure, but I'm pretty sure that Mellon took over the Bank of New York. The fact that it was called a merger is really just saying that they didn't buy them out. It wasn't a hostile takeover, that we want to work with them. It's more a way of saying that we're not buying this to fold into our big evil empire. It's saying we are trying to make ourselves better by working with an equal.
So, but are there stocks traded separately though?
No.
Okay.
Once you become one company, someone bought out the other. However, to go back to your question, which was about goodwill, on mergers, the goodwill probably more often than not is going to be pretty low because presumably, you're not buying them out, you're not saying we want to make this tremendous leap into some other, sector by buying this company out, so we have to throw enough money at them to finally sell. There are going to be two companies that come together on mutual terms, so there's probably a slight premium paid in terms of, Bank of New York Mellon, the Mellon shares that were issued out to cover or traded in for the Bank of New York shares, which no longer exist. But if you understand, does that make sense? Why the goodwill would be less during a merger? Basically, mergers aren't mergers.
But who's paying who the premium then? Like, it depends on who's acquiring control.
Yeah, it depends on who is taking over who. There's always a company taking over another company, but it's usually, like in the case of mergers, it's not that evident.
Was it able to have Warner merger because they combined their stuff?
Yes, but I believe America Online actually bought out Time Warner. But they called it that. They called it a merger, and they kept, or it might have been the other way. No, it was the other way. Time Warner, I believe, bought out AOL.
So M&A are essentially the same.
Yes. They're all acquisitions.
But there are different from joint ventures.
Yes. Joint ventures are, you have company A and you have company B that aren't really related, but they're going to collaborate on something. That doesn't really affect their stock or how that's traded. That's more of something we're putting our collective heads together for research and development purposes, and we're each going to hopefully make a return off this investment in trying to create a new product. But to give you actually an example of an acquisition that happened recently, a couple months ago, Pfizer bought out WUSIF. WUSIF was a very large drug company, and Pfizer is an even larger drug company. That was not a merger because they did it pretty much, they threw enough money at them. It's sort of the difference between let's come together versus I'm going to pay you enough until not joining us just looks like ridiculous. Yeah. I mean, if I said to you, let's go to the movies or something, and you said, no, I don't want to hang out with you. Fair enough. But if I said I'll pay you $1 million to go sit through a movie with me, you'd probably do it, right? I may be the crazy person that's talking accounting, but it's $1 million, and eventually there's a threshold. In economics, you learn about this where you can't refuse the money. It's just insane to do so. But that's where the goodwill comes from. It's the price paid. It's how much more to get to that insane amount versus what the company's actually worth. Identifiable intangible assets. Goodwill and this line item intangible assets are both technically intangible assets. That means they're not something that you can pick up. Tangible asset would be something like the inventories or the property, plant, equipment. You can go, you can see it, you can walk around or throw something at it or pick it up and throw it depending on what it is. Goodwill is an idea. It's the idea of a premium. Other intangible assets would include things like patents. It would include development costs that you have incurred. Other accounting for intangible assets is pretty difficult actually because some have indefinite lives, some do not, and some are not actually brought up on balance sheets at all. So think about patents, copyrights, and trademarks. Trademarks have an indefinite life. So if you have a company, let's say you're XYZ company, and you want to buy out a smaller company, but a smaller company with a nice name to it, then what you do is you buy them out and you say, well, this copyright, which we can, because of copyright laws in the United States, let's presume for simplicity that's where you're operating, we can renew this and renew it and renew it. The trademark of this company will and always will be, let's say, General Electric. It's existed since the 1800s and the name isn't changing and no one else can use that name. All you do is fill out a form every couple of years, submit it, and you're good to go. Things like patents or copyrights, those have identifiable lives. Those you have to actually do something similar to depreciation. It's called amortization. It doesn't list amortization here because it's not a particularly large expense, if I had to guess, especially compared to the $8 billion of property and the only $1.4 billion of patents. Basically good ideas that we have the rights to. If you go into note 7, which is about intangible assets, pretty sure, you will see how they break down amortization, what it is based on, whether it's this patent or that patent, or a company name that we acquired, but they're amortized. They are written down because depending on what it is, patents have a useful life. If you're a drug company, you make Lipitor, let's say, for cholesterol or blood pressure or whatever it does. You can only make that for so long, exclusively before the generic drug companies say, okay, now it's public information and we're all going to start making Lipitor or the generic equivalent. In that case, the useful life, similar to depreciation, would be the exact amount of time between how long it takes for your drug, how long you have to hold on to that and be the exclusive manufacturer of that. So that's one tangible example. Let me show you something else. Coca-Cola Company is 10K. We go down to the balance sheet. You'll notice that out of the $48.6 billion that Coca-Cola is worth, on paper, there's only about 6.6 intangible assets. What is the number one, let's say, how can I describe it? What is the largest asset that Coca-Cola has?
That's not my name.
Yes, close enough. I would have said the secret formula.
Yeah, I was going to say.
But that is a trade secret. That is not disclosed. Coca-Cola, if you were going to sell it, I can guarantee you would sell for way more than $48 billion. It would probably sell for more than $100 billion. It is, I believe, Coca-Cola itself, not counting all the other things they make, the best-selling soft drink on the planet. Obviously, they're not going to patent their recipe because, like a drug manufacturer, they could be the exclusive creator of Coca-Cola for 10 years or something like that. And then they'd have to give it up, and other people can make them. Trade secrets that are developed internally do not get a price put on them. So if you look here, you have to keep in mind that depending on what company you're looking at, it may not be entirely reflective, the asset section, of what it is that they have to work with. In this case, nowhere does it say secret formula because you can't value it. Nobody, supposedly 2 people only know what it is or whatever. But without the secret formula of Coca-Cola wouldn't be worth jack squat. Question?
Yeah, doesn't like the Department of Agriculture, don't they like have to be told like list all the ingredients?
Very good question. That has actually an interesting answer. Went over this in an accounting class I took about a year ago. Coca-Cola and other companies that have secret formulas or secret recipes submit to the FDA, the Food and Drug Administration, a list of ingredients. The list has to be, it doesn't have to say how much, unless it's a dangerous substance, but generally they're not going to be putting that in there. They have to say how much of everything is in, or not how much, but just what is in Coca-Cola. If you open up a can. So while they, obviously if you look at the back of the can, it says, natural and artificial flavorings, they have to go a little more in depth when they actually tell the FDA, who signs off on their ability to sell this as food, what it is. They send them a list of ingredients. It's really, 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 really long. And basically they say any of these may or may not be in our product at any time. Granted, only Coke knows which 5, 10, 15, 20 items on the list of 100 maybe are actually put into a can of Coke. But, it says, they have to submit that, like you said, but they may say celery juice, totally benign substance. The FDA can't say, well, we're going to fault you for putting celery juice in your cans of Coke. If anything, they'd say, fine, that's healthy for people to eat and whatever. So they throw 10 ingredients and 50 red herrings out there in a single list and say, even if you mix all of these things together, there's no conceivable way that they could be dangerous, and they are all safe for human consumption. So, kind of nifty. Good question. That's assets. Cool. Debt is going to take not nearly the same amount of time. I know you're sitting here kind of, raise your hand if you're bored. Raise your hand if you just lied to me by not raising your hand. All right.
He's not going to be happy.
I fully admit this is pretty dry and it's really nice outside. Let's talk about liabilities. Basically, this is debt. It is what you owe to other people. They may have let, you have a line of credit, or you may have issued bonds or notes. Subtle difference between a note and a bond. I don't actually know what the difference is, but it's what you owe. If you look here, it's divided into current and the ones obviously below it, between total liabilities and the total current liabilities. These are non-current. Current liabilities, current just means within a year. Within the next 365 days, what do you owe or what will you owe? In the case of PPG here, short-term debt and current portion of long-term debt. That just means, we borrowed this from a bank and we're going to owe it back. If you have a loan that's 1 year, that would be short-term debt. If you have a loan that's 20 years, but you have to pay it back in installments, that would be long-term debt, but that would be included up there in part as the current portion of long-term debt, meaning, let's say you have a mortgage on your house, you owe them $100,000, the bank, over the next 30 years. But every year, within the next 365 days, you're going to owe the bank, I don't know, $3,000, let's say, with the interest and everything. Well, then you have to report that separately. You're going to subtract out the $3,000 you pay from the total amount you're going to owe the bank at the end of your mortgage cycle, and you're going to say that's current. That is within the year. That's the only difference between current and non-current is the 1 year or less versus the 1 year or greater designation. Asbestos settlement. I brought PPG up because they have some interesting things on their balance sheet that you wouldn't see otherwise. In this case, they owe $534 million for a lawsuit that happened. They owe for asbestos. I mean, does everyone know what asbestos is? It's basically nasty building material that everyone thought was really cool because it was flammable.